Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. When it comes to the mutual fund industry, it's easier to trust fund managers that have been around the block. And of course, you have new kids on the block that tend to do really well sometimes, but then the question always arises, should you bet on this because is this going to be a sustained performance or is this a flash in the pan? So how do you judge schemes that have been launched and mutual fund houses, in fact, that have opened over the last 2 to 3 years? That's exactly what I'm asking Harsh Kumar, who's joining me today, managing partner and co-founder of Zvest Financial Services. Harsh, thanks so much for taking the time. Let me ask you at the onset, when you are looking at a list of mutual fund houses that you want to consider offering to your clients, what are the parameters that you think of? And particularly when you're thinking of relatively new fund houses and schemes, that is those that have been launched maybe after 2022.
So Alex, if we look at the newer fund houses, performance is definitely not a benchmark which we rely on, because we strongly feel that we need one market cycle to assess how's the performance, because at the beginning of any fund, it's all about stories and performance comes later. So from that point of view, what are the few areas which we as advisors focus on? So first is the people who are in the fund house. So when I say people, it's not just the fund manager, but the analyst team also. So we want to make sure that there is sufficient number of people with experience who can do justice to the ever-growing pool of listed companies in India. So that is part number one. Second is processes, because sadly we have seen a few accidents in this industry in last 5-6 years and even before that, and we believe that this is a business of trust. If you go wrong on processes, then market doesn't forgive you. If the performance is here or there, still people tolerate you. So that is an area where we focus a lot. Third is we focus on how the fund is differentiating itself from other. Now, there are two ways in which one can differentiate. One is that one repackages itself by making it look differentiated, which we definitely not encourage. But on the other hand, if there is a genuine differentiation that we like. So there are funds which we have seen, they say that, they are fundamental, but they end up chasing momentum. Then there are fund houses which say that they have a strong analyst team, but they end up doing very little primary research. So these are the kind of parameters which we look at on the qualitative side of it. And then definitely on quantitative side, we look at what are the kind of standard deviation which the fund house is running. Is it in sync with the profile of the investors who are going to invest in that? What is the kind of additional risk beyond benchmark the fund house taking? What is active share of these funds? Are these benchmark hugging? In that case, we don't need a new fund. Or are these guys genuinely doing some work and thereby creating an active share? What is the performance of the fund when the market moves up, and how does it capture that? And similarly, how does it capture the downward movement of the market also? So these are the few factors which help us decide whether we should be taking a bet on one fund house which is relatively new, where the performance track record is not there for last 5-7 years.
Just want to talk about the number of schemes though, and Harsh, quite a few of them have been launched in the recent past, and just wanted your perspective on that, because somebody who is not really familiar with the way that wealth management company or asset management companies globally function and what the landscape is, they would think that the 50-odd scheme, not schemes, but 50-odd fund houses in India would be a large number. But you're talking about thousands of fund houses in the US, right? And that's the market, right, ultimately, which is the largest market in the world. But we're nowhere close to that. But having said that, right, there is still a large amount of concentration. The new schemes and new fund houses, it's good, but they don't control a lot in terms of AUM, right?
No, you are absolutely right. So before I get into the numbers, let me describe the evolution of this industry. Now, I would classify it into 4 different phases. Now, the first phase was the PSU era, when only public sector entities could be into this business. And the first fund house in our country was UTI Mutual Fund, which started in 1960s. I think 1963 was the time when it started. And then it was the only fund house for a very long period of time. And in mid to late 80s, we had SBI and LIC participating in. Then in 1993, Security and Exchange Board of India came out with a regulatory change whereby private entities could also participate in this business. And that was a phase when over a period of 7-8 years, we saw marquee names participating into this. Names like Tata, Aditya Birla, Kotak, HDFC, ICICI, they entered into this business. Now, there were two distinct feature about this phase. One, many of these players had a JV with a global entity so that they could get the best practices from there. And it was a new business for these guys, so it made a lot of sense. Secondly, these guys had distribution strength on account of their parent being a bank, be it HDFC or even ICICI. So they capitalized that fully. Third phase was an expansion phase where over a period of 18, 19 years, starting 2000 till 2019, we had a lot of newer players like Axis, Mirai, Edelweiss, Motilal Oswal coming into this business. But the last 5 to 6 years have been very, very exciting. And I would call it disruptive phase. In this phase, we have seen companies from different background coming into this. Just to give an example, today we have brokers and wealth management firms like NJ, Grow, Angel One Zerodha entering into this. We have NBFCs like Navi and Bajaj getting into this. We have PMS and AIFs fund houses which never thought of getting into mutual fund like Abacus, Helios, Capital Mind, who have also entered into this business. And now, to add icing cake, we have Geo BlackRock getting into this, where a global giant in tie-up with Indian giant is entering into this business, or rather has entered into this business. So we have seen a lot of disruption happening in this in last 4 5 years.
What are these schemes? I keep saying schemes. What are these fund houses though? And if you were to rank them in the assets that they've currently got managing, how would you rank them?
So, if I look at the last 4 years or 4.5 years, the maximum growth has been seen by leading two, three players. So, first, I've mentioned Bajaj. Bajaj was the fastest to scale in this business. Today, they have an AUM of around 30,000 crore. And even if I look at the bouquet of funds which they have, it's quite huge. Second comes White Oak, which again at 30,000 crore. Again, like Bajaj, it has a lot of funds on its platter. And they also emphasize a lot on the active management they end up doing. So that is their core competence. Third, again, a very, very fast scaler has been Geo BlackRock. And one of the reasons why they could scale this fast, their current AUM is around 16 to 17,000 crore, is because they had a strong institutional tie-up. And these guys could capitalize on that and build AUM very fast. Then comes Zerodha at around 15 to 16,000 crore, followed by Navi and Helios at around 9 to 10,000 crore. Now, if I see this entire universe, barring Geo BlackRock and Bajaj, which had some friendly money from their promoter because their sponsors had huge treasuries and some of that money moved into money market and liquid fund. None of the other fund houses has focused on debt as a part of the portfolio. It's primarily equity focused fund houses which have got launched in last few years. Debt is just an incidental part of it.
Okay, all right. What about the strategies? And a few of these are passive led and primarily passive oriented. In fact, even Geo BlackRock, for that matter, was supposed to be primarily passive led, but they have changed that, haven't they?
Right. So, like I mentioned earlier, passive is relatively easier business to get into. Even if, because here you don't have to carry the burden of negative alpha or underperformance. You just launch a fund, ensure the tracking error is on the lower side, and you can manage it over a longer period of time. So the strategies of launch have not been very, very differentiated, but the packaging has been different. So, like you rightly said, on one hand, we have fund houses which came with a passive only strategy. There, they said that we are price disruptor. You would end up paying lower fee here. It's been happening in the West. It will eventually happen in India. So why don't you participate in passive? So fund houses like Grow, Zerodha, Navi, even Geo BlackRock when it started. So these are the fund houses in that category. Then the second spectrum is those guys who say that we have done AIF, we have done PMS, we have had strong track record, and we want to give that track record or pass that track record to retail investors also. So fund houses like Helios, White Oak, Abacus, they got into this business pitching on their active proposition. Then there is a third category also, like Samco. There they said we will do only quant-based investing, and not many players in the industry are doing quant for all their funds, but they said we would do that. But honestly, if you ask me, over last few years, most of these guys or many of these guys have moved into a blended strategy. Like you mentioned, Geo said that we would do passive, but they have now moved to active. Navi was only passive. They have also moved to active. So they got the funnel of investors, they got the database of the investors, and now they are using that to pitch them active funds as well. Within active category also, when these funds were launched or fund houses were launched, some of them came out with a lot of stories around certain themes. And a lot of thematic funds were done, be it healthcare, be it banking and financial, be it other funds. Now that they have got investors in their fold, they are pitching them the regular vanilla funds like flexi cap, large cap, and all those things. So this is how the evolution has been. I won't say that the strategy wise they have been very, very different. Like some players said that they would do direct only. Geo, BlackRock, and Zerodha, and now we are hearing that Geo is even considering empaneling distributor. So with the market evolving, I think these guys are also changing their strategies here and there.
The, okay, so that makes sense. But how have they performed, Harsh? And ultimately, that is your benchmark. That is going to determine whether or not people come and invest in you. As much as you say, don't judge a scheme's performance by or whether or not you should invest in a scheme purely by its returns. That, let's face it, most people decide based on that. We're not saying that you should, but how have they performed?
So before I get into data, I would want to tell the viewers that please don't go by this data point for making your investment decisions, because like I said earlier, you should see the fund over one market cycle, and that could be 7, 8, 10 years before you make your investment decision. Because if you haven't seen the performance of a fund during bad times, you can't make clear assessment about the performance. Having said that, just to give some idea to the viewers, now, what we tried to figure out how do we give you the average return. So I took out the active funds of these fund houses because passive doesn't make any sense in terms of our calculation. Took the average of all the active funds which these fund houses run to arrive at the number so that you could get some idea about it. Now we don't have, unlike legacy funds, a track record of 3, 5, 10 years, but most of these funds are 2.5 years old. So I can give you that data. If I look at last 2 years data, and this data is as recent as day before yesterday, White Oak leads the pack with a return of around 10.5%, followed by Helios at 8% and Bajaj at 7%. If I look at last 1 year, the average performance of the fund houses, then Helios lead the pack with 11% return, followed by White Oak at 6.5% and Bajaj at 5.5%. Now, one of the fund houses which we haven't discussed in our conversation till now, which has done really well for last 2 years, is Old Bridge. It has given a performance of 9% plus for last 1 year as well as last 2 years. But the reason we didn't discuss it because the AUM of this fund house is around 3,000 crore, which is not a very meaningful number for our investors to make some assessment about. Now, if I have to go one level deeper and see how's been the scheme returns. Now, obviously, we can't compare all the schemes here, but I went by the flagship schemes of most of these fund houses, which is Flexi Cap scheme. So in FlexiCap, last 2 years, Helios and Bajaj have almost had similar returns and both had good returns. If I look at last 3 years, then White Oak also looks very good with 18% CAGR, which is a very strong compounded return over last 3 years. So this has been broadly the performance of these funds.
And there are some that you have not mentioned that have not done particularly well, particularly over the last 1 year, right, Harsh? Because if I look at Samco, for example, and the FlexiCap fund, it's not really done well. So bear in mind that betting on the newest horse in the race is not necessarily always a winning strategy. We've spoken about how you should decide that, and Harsh, just to close out, and this would necessarily have to be a quick answer, out of the schemes that we've discussed, out of the fund houses that we've discussed, for that 2 to 3% allocation, who do you like and who do you normally advise? And this is not necessarily a recommendation. I just want to know what you've shortlisted from the list.
So, Alex, before I get into that, I'll tell you the process we follow. I'll not take more than 1 minute.
Yeah.
We have because this is not our own money. This is fiduciary and we have to be very, very responsible. So we have certain filters at our end. And basis those filters, we arrive at the fund houses. And in those filters, performance is one part, but it's not the entire thing. So it's not that I would look at last 1 year, 2 years return and I'd start recommending. So the filters are, what is the size of the team? Because we don't want a situation where a key man leaves the fund house and our investors are struggling to cope up with the returns. So one is, how big is the team? Second, what kind of primary research they are doing? What are the kind of active share they are running? And lastly, like I discussed earlier, are they really differentiating from the existing scheme? Because if I have to give a similar underlying in a different name, it doesn't make sense for any investors. So keeping in mind a few of these filters plus a lot of quantitative numbers, which we keep studying. At the moment, we are recommending FlexiCap schemes of White Oak and Helios. We have been deliberating on Bajaj also, but as of now, we haven't shortlisted any scheme for our investors. But having said that, I would again say that these schemes are just to add the flavor, because unless you go through a beer phase, you really don't know the performance of the fund. Till that time, it's just stories, and it's not performance based analysis.
Yeah, absolutely. All right, Harsh, on that note, thanks so much for taking the time. Pleasure speaking with you.
Thank you, Alex.